Hey everyone, welcome back to Corporate Decoder, the place where we unravel the mysteries behind big business reports and, well, in this case, the mystery behind Navient's latest 10. K-filing where it seems they've been shedding a lot of business like a snake sheds its skin, and that has got us diving deep into their numbers to see if it's a good thing or a bad thing. This report is massive, covering a full year of operations for Navient Corporation, and it details their financial health, their strategies, and the big risks they face, especially those nasty legal and regulatory issues that always seem to pop up. First off, Navient is a big player in student loans, primarily managing private education loans, and also a huge portfolio of federally guaranteed Federal Family Education Loan Program, or FF loans. Now, they've been making some significant strategic moves, recently selling off their healthcare services business in September 2024 and their government services business in February. 2025. Looking at the numbers for 2025, it's a bit of a mixed bag on the GAAP basis, meaning according to standard accounting rules, they reported a net loss of $80 million. That's a big swing from the $131 million profit they had in 2024. That means they lost about 81 cents per share compared to earning $1.18 per share last year, but they also like to look at things their own way using something called core earnings, which adjusts for certain volatile items. If we look at that, they had a net loss of $35 million in 2025, compared to a profit of $221 million in 2021 million. In 2024, while that loss is smaller in core earnings terms, it still shows a significant drop in profitability from the year before. What caused this hit? Well, a big part of it was a massive jump in their provisions for loan losses. That means they set aside way more money in 2025 to cover potential defaults. On loans provisions for private education loan losses, a loan shot up by $137 million. This is a clear sign that they are seeing more risk in their private loan portfolio. Let's break down what happened to their money in 2025 versus 2024. Their total interest income dropped by 18%, which is a substantial amount. This was partly because their loan portfolios are shrinking as old loans get paid off, but also because of how interest rates moved, affecting their different types of loans. On the flip side, their total interest expense also dropped by 21%, but the gap between what they earned and what they paid out net interest income actually went down. That means their costs are decreasing, but their income from interest is decreasing. Even faster, expenses saw a big decrease too. Operating expenses were down 38%. This is largely thanks to selling off those business processing units we talked about. That includes their healthcare services, business in the third quarter of 2024, and their government services. Business in early 2025, they also had a substantial reduction in goodwill and acquired intangible asset impairment and amortization expense because they sold off those businesses. Now let's zoom into how their core businesses are doing. The consumer lending segment focuses on private education loans, their private loans, and their Earnest brand, which offers refinancing and new school loans for students. And here is a bright spot: loan originations, or new loans they gave out, surged by 77% in 2025 to $2.5 billion. That's a really strong performance, showing growth in this area. However, their net income for this segment dropped significantly from $196 million in 2024 to just $20 million in 2025. The reason, again, is that huge increase in provisions for loan losses. These provisions increased by $137 million, which means they are much more concerned about borrowers not being able to pay back these private loans. This segment deals with a massive portfolio of government-backed FFELP loans, HERAs, where things get a bit strange. Net income grew slightly to $115 million. But listen to this: FFELP loan prepayments dropped dramatically from $5.4 billion in 2024 to just $977 million in 2025. This means fewer people are paying off these loans early, and when interest rates decrease, this has a big impact on their earnings because of how these loans are structured. The allowance for loan losses, specifically for their private education loans, ballooned to $364 million at the same time. Their net charge-offs, the actual amount of defaulted loans that they've written off, remained pretty high. This indicates that while they are building up reserves for future losses, they are also seeing a lot of loans go bad right now. Now, for the scary part, the risks Navient faces, and there are many. First and foremost is credit risk. This basically means the risk that their borrowers won't pay them back. This is directly tied to economic conditions like unemployment, inflation, and interest rates. They're also exposed to market risk, which boils down to changes in interest rates and how that affects their profitability. They also highlight funding and liquidity risk. This is their ability to get the money they need to operate and pay back their own debts. A bad credit rating could make it much harder and more expensive to borrow money. And guess what? Their credit ratings are below investment grade, meaning they are considered risky to lenders. This sentence is super important. It means the way they borrow money and the way they earn money on their loans don't always line up perfectly. This mismatch can hurt their profits. And like everyone else these days, they are walking a tightrope with cybersecurity. A breach could be catastrophic, leading to huge losses and a damaged reputation. And they specifically mention their move to cloud-first architecture in 2025 as increasing these risks. Finally, let's talk about their allowance for loan losses. They admit this is a critical accounting policy that involves a lot of judgment, and estimates they have to guess how many people will default. And how much they can recover this is especially tricky for their private education loans, because these are the loans where they bear the full credit risk, unlike the government guaranteed F. ELP loans and their forecasts for these loans depend heavily on predicting economic conditions, which as we all know is incredibly difficult. So what is the big picture here? Navient is clearly in a transformation phase, selling off businesses and trying to focus on growth in their private loan originating arm. The surge in originations is positive, but the huge jump in loan loss provisions, especially for private loans, is a major red flag. They are making money on paper through core earnings adjustments, but the APAP numbers show a significant loss and increasing risk in their core loan portfolio. The company is also dealing with significant regulatory and legal risks, which are always a cloud hanging over financial institutions. Navient is trying to navigate a complex landscape with a declining FLP loan portfolio and an increasing reliance on private loans, which come with much higher risk. The strategy seems to be growth over the long term, but the short term shows they are facing real challenges with potential defaults and the ever-present risks of economic downturns and changes. It will be very interesting to see if their growth strategy can outpace the increasing risks in their loan books. What do you think about Navient's strategy and these numbers? Let me know your thoughts in the comments below. And if you appreciate these deep dives into corporate filings, make sure you hit that like button and subscribe for more content. And don't forget to check out our Discord community linked in the description below to keep the conversation going. Thanks for watching, and well, see you in the next episode.